Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, well, I mean, it's afternoon now, I guess. Lunchtime for most of you, unless you're on the West Coast. We got Federal Reserve announcement here in 5 minutes. So remember, we are pretty confident that it will be a 75 basis point hike. Not that it's like impossible for a 100 basis point hike to happen, but I think it's I will be so shocked. That will be the most shocked you'll ever see me if they do 100 basis points, okay? But I think that the thing that will probably matter is the dot plot. So especially if we see points on the dot plot beyond 4.5, market's probably going to freak out. Overall, probably we're going to be extremely volatile. I have my accounts turned off at the moment, so disabled. If I put any orders in here, there's some orders, right? I guess we could try and build a position out here in the 5 minutes before just for gambling purposes, but nah, we're not going to do that. We're not going to do that. I spoiled you with 2 streams, Scott. Oh, I appreciate it. It feels so good to know that you guys appreciate the content that we're making and are actually, sometimes I'm like, do people actually listen to this? Why would people listen? But you do. Well, it is useful stuff. You know what? If I was not me, I would probably listen to me. I think so. Yeah. So, we got anything extra going on here? Oh, okay. Oh, who's this? Oh boy. How were they able to post a link to another Discord and not get immediately banned? Well, that's weird. That's weird. Going now. You're going to build that liquidity hole trading bot? Well, the problem with the whole thing with the liquidity hole is that kind of prevents you from taking a bad trade, right? Doesn't necessarily give you an entry signal, unfortunately. Full 5 lots in ZN. Hell yeah, let's do it. No, I mean, if I do here, I'll bring it up. Okay, so I got the ZN. I'll do 1 lots at a time, but I'll give myself max 5. All right. Let's say like max 5, max loss per trade, $1,000, right? But I'm not going to have a position on before the news. If I get in there and I see something in the tweets or, in all of the information that we get that gives me a trade, then we'll try taking it here on Sim. But overall, this is going to be a crazy move, right? So, oh man, so I had a little bit of my lunch here just before, and it just looks so good to me right now. I just want some more. My mouth is watering and everything. But we got like 1 minute. I don't want to take I'm going to take 1 bite. I'm going to take 1 bite here just before. And I guess I didn't get into it, but we did see a move in the treasuries after we left. They continued moving down, although since that time the 5-year has pulled back considerably. So difficult for me to know really what's going on there. It looks like some bets are being placed. Somebody's definitely long in this market because the 5-year has been pushing against us the whole way. Or you want to just see how the P&L will move? Yeah, have fun with that. Yeah, we'll stick around through the press conference. Sometimes we even stay around until the stock market close. Just kind of depends on how active the market is. I mean, this really has the probability of being a nutso crazy move, so. Here we go. Okay, it's 75. Man, yields sure took a plunge there, though. Looks like somebody decided to sell on that. I don't know if it's going to be so hot for them, but we'll see. The Fed raised rates by 0.75 percentage points. Median projection has an interest rate between 4.25 and 4.5 by December. Okay, so just my gut reaction here off of this. I don't think that I take a trade here on the treasuries, but I think I actually want to fade this in the S&P 500. I think I want to fade this on the S&P 500. I don't even have my DOM up for the micro ES, so I won't try it, but I think I want to fade that. Now, this does kind of suggest I must be missing something, so let's look at this statement. Okay, so they changed. Recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months. And instead, they say recent indicators point to modest growth in spending and production. And that's basically all that changes. I think you buy this. Let's say I caught 38.60. Now, the treasuries, I'm not so sure about that one. It's a zoo, though. I mean, the market was so illiquid. Somebody sold the 10-year there pretty hard, and they were absorbing against it. Like, well, not absorbing against it, but the volume on the pullback, the buys was stronger. Does that make sense? Like, cumulative delta rose even though we took a huge dip in the treasuries. Okay, so here's the plot. Open image in new tab. Now that's some juice, yeah. That's a market that's moving, right? You finally get your volatility kick. NASDAQ trader. Okay, so they're saying that the peak rate, oh, actually that is not what I had just read there on Twitter. There are some people with, oh, it's in 2023. There are some thinking that in 2023 we'll get to 4.75. So that is a little bit more hawkish than anticipated. Kind of like we were worried about. But for... I mean, I don't think anybody in the market thinks that we're going to get to 4.75, though. I don't know. But the midpoint of that is 4.5. The midpoint of that is 4.5. So that's interesting. That's what I was reading, was the midpoint. Okay. There was one official who projects rates rising by another 150 basis points this year. 9 officials have it raising by 125 basis points this year. 8 officials have rates rising by another 100 basis points, and 1 official projects raising rates another 75 basis points. That's from Nick, is what he's pointing out on the dot plot here. Also, an hour ago, Nick Timmeros tweeted, "Some Fed officials have spoken with concern about labor markets being too tight. A key focus after today's FOMC meeting could be on how high officials expect unemployment to rise under appropriate policy in the next 3 years." Looking like it wants to run weak stops. Well, we see this all the time. You get really, really big whipsaws in there, and I'm sitting here like, well, everything is exactly what I thought it was going to be. That's kind of where we're at. That's why I'm like, I think you buy the S&P 5. I think you buy this dip, but it doesn't look like it's working out so well, does it? So yeah, this is why I don't trade this usually. CPI was bad. FOMC is bad. Well, so let's see. What is the damage here? When we come to a volume profile, they're modestly below the previous day's lows in ES. The treasuries, on the other hand, the treasuries, it's quite a excessive dip below previous levels and kind of puts us into no man's land. I don't know. I think that, not say I don't know, we'll see, right? I think that the press conference could end up having a larger impact than the rate increase. But we'll see, because everything that I'm seeing here is exactly what I expected. Everything I'm seeing is exactly what I expected. Was the market expecting them to be less aggressive? I mean, that's what the price action suggests, but it might not be true. One thing I do want to point out, though, we flattened considerably. That was a huge flattener came out across the curve when the news hit. So that, I think, will make the interest rate trade all the more interesting. So let's let this play out. I'm going to eat some food here. We got to keep an eye on the order flow, though. Okay, so here's an interesting one from Christopher Barad on the Federal Reserve's growth forecasts. The Fed cut its growth forecast for 2022 from 1.7% to 0.2%, and for 2023 from 1.7% to 1.2%. And his comment is, "It looks optimistic and suggests the Fed has still not assessed correctly its negative impact on the economy." I think that that's actually probably correct, because the market seems to expect that we'll be in a recession next year. There's like zero resting. Yeah. Liquidity in the 10-year is pretty awful right now, right? I'm not done watching FOMC front care what he has to say. It's superfluous anyways. Oh, you're done not what? Like, here's the thing. Is you get low liquidity and like every day trader is out there watching this thinking, oh, like it's moving. I gotta make a trade and make something off of this. This is why I stay out, because unless there's like a really strong break of market expectations, I generally don't want to trade it, because we see this all the time where everything comes out exactly in line with expectations and then the market still makes this huge move and then like it completely retraces. So we'll see. I was saying 38.60. Was probably too generous because they went all the way down to 38.40, but you know, we should just wait and see, because the market will do all sorts of bizarre and unusual things simply because people are click happy right now, right? The number of market orders out there just way overwhelms all of the limit orders, even though there's maybe no real reason to be trading, right? What is that? What do we call that? Traders gonna trade. Those are pretty insane. Like, I do have to say though, the move down immediately after the news in the treasuries was quite shocking to me. That moved down a ton. Nobody cares what the rates are? Well, first of all, there are people that do care what the rates are, but the people that don't care will still be impacted by it. Right? You think somebody puked hard? I do wonder if somebody maybe had a bullish bet. Like, going into this news, I think if I was making a speculative bet, I probably would have betted long. I probably would have betted risk on in some form, thinking that the market will be relieved in some respect. Like, if it's not 100 basis points, the market will be relieved or something like that. So I really do wonder if somebody is puking hard there. Yeah, I think that's a likely theory. I mean, so, in action like that, somebody definitely stopped out. It's just a question of, was somebody stopping out instrumental in it moving down as much as it did? No way to know, I guess, but now I want to just point out here in the treasuries, man. So I'm going to come over to this other chart. Look at this. The cumulative delta in the 10, the 5, and the 30 are all pointed higher despite us moving down. I have never seen a divergence like that in the treasuries ever. I did not think it was possible. Are the bonds buying the dip here? I have to wonder. That is really bizarre. Man, if this reverses and the treasuries end up getting above the news price, that's going to be awfully hilarious. We're going to be sitting at that and we're like, look, the order flow was telling us what's going to happen and we didn't take it. Okay, Trading Bunny, one thing I'm confused about, I thought that large moves happened because of illiquidity, true, but if I look at volume traded in that initial move, there is a lot traded around there. Well, I don't really have many metrics on here to tell you exactly how many contracts traded, but you got to look at the DOM here, right? Normally earlier today in the treasury, we were putting 2,000 contracts per price, right? We were putting 2,000 contracts per price. Now we're only putting up 500 in most spots. Okay. So volume coming in will move price more because of the illiquidity, right? Right. So illiquidity doesn't mean low volume, right? Liquidity, volume, two separate things. When we're talking about volume, we're talking about the market orders. And when we're talking about liquidity, we're talking about the limit orders. So when there is high volume and not very much liquidity, you get extremes in volatility. Yeah, there you go. And the reason you got to be careful about that. So let's come over. I'm going to add another chart here so that we can see it. Okay. I'm going to select a ZN here and 1 minute chart. Ew, why did it make it so big? I'll just put regular volume on here. We can zoom in. Okay, so on that down move, there was 30,000 contracts short. Well, not short, but 30,000 contracts in the treasury. That is a lot. That is a lot. Although what they've been trading per minute after that isn't actually all that crazy. So this is a situation where I think there's a really good probability that the treasury comes all the way back. I'm not sure I believe in it enough to like put money on the line, but man. Tommy Williams, I'm new here. Hey, thanks for saying hi. You know, we have a couple of new people here today, so you're in good company. I have to say, every generation of people, because listen, I think that we have a lot of really good information, but trading is still hard. And, you know, we have people fail trading here just as much as anywhere else, and people come and go. I have like this core group of people that have been around for like the whole 5 years that I've been streaming this, that are just amazing traders and have been around forever. But, you know, we get new people, will come in and come go. And I feel like that every set of newbies that comes in is better. Like the set that I've seen come in lately, you guys ask really good questions. You're really engaged, like you clearly understand the content. You like the music? It's a Stream Beats. So streambeats.com is what I'm using for the music. I wanted something a little relaxing though, because you know, Federal Reserve can be a little too intense sometimes, right? But let's see here. Tommy asked why watch the Treasury. Okay, so right now, the most important thing that you could be watching is the Treasury, okay? Because basically the thing that's changing is interest rates. So that's what the Federal Reserve has control over, and everything else is reacting to the change in interest rates. So if you want to really understand what's going on, you have to watch the treasuries here, right? Overall, though, there's a lot of really good reasons to trade treasuries and watch them. They're very economically sensitive, and they start earlier than the other instruments, so you can see reactions to things like the non-farms jobs report and the other, high impact economic reports. So that's what makes treasuries really, really good to trade and really useful to watch. Everything else is kind of based on that. And if you can understand the interest rate market, you watch the order flow. I think we were talking about this morning. There's five parts to a good strategy. You want to have risk management. You want to have predictors of order flow. You want to incorporate breaking news. You want to look at correlations, and you want to look at the order flow. Okay, if you have those 5 things together and you figure it out on the treasuries, you go anywhere else, it's gonna be easy, because treasuries are the hardest. The best traders, if you're at a bank and they say, oh man, this guy, he is so good at trading, he's really knowledgeable, where do they put him? They put him on the treasuries. They do. These are the best traders, are in the treasuries. Okay. And to what Seth said, if you watch anything else, you will lose. Oh, don't tell him that. But I would avoid NQ. So all of the people on my stream that trade NQ are triggered now. Where's NASDAQ traders NASDAQ killer getting mad at me for that one? That's NQ is a disaster for me, says Captain Price. Dude, and NQ is the Widowmaker, man. I'm gonna bet you that NQ is responsible for more broken accounts than anything else. It's just too tempting for him. There was another, what was the other one that I want to, telling people who don't trade why the market will fall is hard. The 401k people and your relatives, it's like impossible to explain because they don't trade. Well, all you got to do is tell them is that markets are not informationally efficient. That's the real key here, right? This is the thing that everybody believes that is false and causes so many retail traders to waste their time. They believe that the market is informationally efficient, that if the market sold on this event, that means that they know something about this that we as individuals can't figure out, but everybody together, they know the right answer every time. And therefore, it's complete nonsense. It's complete nonsense. The market is not informationally efficient. The price that you are seeing only reflects the people buying and selling it. And the people buying and selling it can be buying and selling it for completely random reasons, right? This move that we had here, does that mean that the Federal Reserve was too aggressive? Does that mean this is bad for markets and that they really should be backing off rates right now? It doesn't mean any of this sort. It's probably just people had positioning before the move and they were wrong. You know, it doesn't tell you anything about the fundamental picture underneath. Once you understand and accept that, trading is so much harder, because now you can come in and you can be like, hey, this is what everybody else believes. Here's how I know for a fact that that's wrong. Now all I have to just do is wait for that opportunity where they all realize that they're wrong and trade it. And that's where the big winners come from, right? Markets are not informationally efficient. This is the most important thing in trading you could know. You think aggressive stops below 3,800? Well, there's always stops when we have like a big break of a key level, but I kind of wonder what the gamma looks like below there, because I'm going to bet you that there's probably some incentives for the options market makers to buy once they get below 3,800. So just a little bit too close to the current market action. I don't think that could be like a key trigger where they have to start selling into it. But I could be wrong. I listened to your interview with Gary Norton. I'm curious, do you think price is random or manipulated or pure supply and demand? Okay, so I think that, so when you talk about is price random is really an interesting subject, because for all intents and purposes it is, but it is actually not. So we have been able to tease out a number of empirical properties about the behavior of price that does not match a random walk. Okay, so it is not actually random, but for all intents and purposes, us sitting here trying to watch price and trying to pull something out of it, it's basically it's random. Is it manipulated? Sometimes. And it's not even really manipulated. It's just you have to realize that what you're seeing, the price is just a reflection of people buying and selling, and whether they choose what prices they decide to buy and sell at, and whether they choose to use market orders or limit orders. That's it. That's what moves the market, right? So if it's a slow market and the market maker is dominating the action, there's not really any reason to trade, and all of the retail traders get in on the momentum and think that it's going to go one way. The market maker probably going to make it easier for it to go the other way and screw you out of it, right? But if somebody has informational edge, they know something that the rest of us don't, right? They know what's going to happen. It's going to go that way, you know? So I don't think that you could say it's manipulated. Is it pure supply and demand? I wouldn't use the word supply and demand, okay? Because when you use a supply and demand is kind of like, you know, this economic theory about supply and demand where you have a supply and demand curve, and this is how much supply changes when demand changes and how much demand changes when supply, right? That whole thing, that doesn't apply to stocks, okay? Because the whole idea with supply and demand is that supply and demand are actually very elastic. And the reality with markets is that markets are the exact opposite. A new order coming in, a set of new orders coming in to buy the 10-year treasury actually has a very large impact on things. Okay. You'd be surprised how few contracts it takes to actually move the market in a direction. So price is very inelastic. This is what we talk about in my video about the inelastic markets hypothesis, where we go into that a little bit more. Okay, so I wouldn't use the word supply and demand, okay, but it is a pure reflection of people buying and selling, yes. It is a pure reflection of the orders that the market participants pass into the market. Like if you think about the market as the matching algorithm that is at the heart of the exchange, that is 100% deterministic. You pass the orders into it, it will come out the exact same every time. So it is a pure reflection of the orders that are placed into the system. Okay? It's just that people make the mistake of saying, well, that means that I can look at what orders have been passed in now and be able to predict what kind of orders will be passed in 5 minutes from now. No, it doesn't work like that. You can tease some information out of that order flow. It can help you identify good locations. Oh yeah, we need to pull them up now, huh? Okay, so first of all, let's turn off financial juice. And we'll turn off me, so that we can have a nice big spot for Jerome. YouTube.com/Federal Reserve. people tend to blame the market is being manipulated when they lose. Yeah, for sure. The most frustrating thing to me in trading is that, like, you have these people, they think that they're doing really, really well, and then they completely blow it. They lose everything all at once. And, okay, so why did they lose? When you talk to them about it, nobody ever says, well, I guess my strategy doesn't actually work. I think I was just lucky before, and clearly the strategy is flawed, right? Never happens. It never happens that way. They always blame that it was manipulated, or that they blame their psychology, right? And this is how technical analysis is able to live on, even though basically every piece of empirical evidence we have says it doesn't work very well. That markets are more statistically efficient than they are informationally efficient. I wonder if you could theoretically predict how the exchange algo would pair orders, and then if you knew depth, you could forecast price delivery. Just using, well, so if you know the future orders, you can predict price quite accurately. Yes. Okay, here he's gonna go.
Good afternoon.
Oh, somebody needs to turn their phone
My
on.
colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
Okay, well, him starting out like that isn't a good sign.
Resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level.
It's an interesting drop and come back in the treasuries so quickly.
Longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%.
What is this?
Price pressures remain evident across
Gold
a broad
is
range of
rallying at the moment.
Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2000.
Nah, I think this move in gold could be significant.
To inflation as weighted to the upside.
It should not be moving up,
Despite
given the way
elevated
everything
inflation,
else moved.
longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not.
Something has changed today.
The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with
Gold
inflation
must be
return.
moving because the dollar is coming back down to earth.
We anticipate
After touching almost
increases in
111, they're back to
the federal funds rate will be
110.45.
appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions.
What would happen if the dollar crashes?
Our thinking
Well,
as
okay,
clearly
like not the. It's not a realistic scenario that the dollar crashes, but if the dollar started declining here,
some time.
it would be good for everything else.
The historical record cautions strongly against prematurely loosening policy.
The strong dollar right now is like the biggest problem in
Median
the market.
projection for the appropriate level of the federal funds rate
Paradoxically,
is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities.
gonna do a make a phone pattern if they break
Everything
the
we
over
do is
the
in
daily
service to
high
our
on
public mission.
daily level.
We at the Fed will do everything we can to achieve.
I did. I said I want to buy it, right? I wasn't gonna take a trade in yes because I don't even have it up, but I said buy. I don't think that I would have taken that much heat on a trade like that, though. This is like 30 points of heat. No thanks.
From the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
Give the first question to the
So I will answer your
New York Times girl.
question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole.
Thank
The
you.
FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
Boom. Translation, I liked how you reacted to Jackson Hole, and I want to assure you that it's still the case. You should still be scared.
To accomplish that, we think we'll need to do two things in particular.
I don't think I gave a very good translation there, did I?
And also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off.
Find it funny how they bring projections and say right after this is not indicative of future results and no one can predict what the outcome will be. Looks like a trader's video disclaimer. Well, but it's much more than that. The Federal Reserve understands a little too well that their projections are unlikely to be realized.
We think that we'll need to bring our
Jackson Hole
to a restrictive level and to keep it.
So a month ago, the Federal Reserve had their yearly Jackson Hole conference, and
We'll be looking at a
the
few things.
chairman gives a headlining talk, and he really scared the markets, and he's basically saying, listen, my opinion hasn't changed since then. So if you guys thought that interest rates were going higher, that the Fed was resolved to get down inflation a month ago, we are still just as resolved.
Of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Well, the 10-year has recovered
Thank you, Mr. Chairman. Steve Lee.
the losses. How far was it?
About how you factor in
20,
the variable lags on inflation
60.
and the extent to which
60, huh?
the outlook
6 basis
for rates
points.
should be seen as
6
linear
basis
in the sense
points
that
up
keep
and then
raising
back.
rates? Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate?
Good question.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. And changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now,
That was probably the funniest thing that's ever happened in an FOMC.
I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
We gotta clip that now, man. That was hilarious.
For taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored.
It might not be frozen, Kyle. It may be that there's just no volume going through the Forex.
To the extent that continues to
refresh it,
that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help.
Here comes highs of the day.
Let me just say how much these factors will turn out to really matter in this sequence of events. It remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Here comes Nick.
Tim Rose at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Okay, so I think that last bit there actually is important, that they do want to see positive real rates across the curve.
The opportunity. I just want to be clear on the Septs. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we
not going to answer that.
One decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
I don't think I completely caught everything that he said there, but the market really reacted to that.
Here, given there's some discussion now of
Saved me. Yeah, it was not looking too hot for me for a moment there, was it?
front loading right now. Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some.
Well, we are going to get the
healing, but inflation has not really come down. If you
the options bit close for the treasuries here in 10 minutes. Yes,
a good measure of where inflation is running now. If you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025 and in the median, and headline is at 2.0. So that's
not what we expected or wanted to be. What that tells us that we need to continue, and we can keep doing another large increase.
I mean, I would say that if actually if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yes. So as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So If you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So
Here's a really good point that I haven't
you never
considered.
wanna overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation.
Yes,
for the
Daddy
6
Powell.
12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down.
Wait, so did he just call all those people that said the Fed was about to pivot stupid? He just said, look, how do you have these inflation? We're not going to back off.
Ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities.
What's got
We've
aggressive?
seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions
Really
there,
shifted, but look, there's break of highs.
affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number
Take $500 if I get it.
that decision. But the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk.
Nick Temeros is tweeting up a storm, and I wonder if those tweets are all actually his.
Risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy.
Who didn't mute their cell phone?
Kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place.
I think they're chasing to cut that probably, D.
Economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases.
Hey, somebody needs to fix the microphone.
On interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. It's a.
But did I get
we've
filled?
said this, this is a strong, robust economy.
Do the tick
savings
too.
on their balance sheet.
Well.
The period when they couldn't spend and where they were getting government transfers, there's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here, with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates?
So I have a
for
question.
recession?
Is the seating assigned, or do they pick where they sit?
Acceptable job loss. And then, given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you
I think these two.
If you've gone too far?
I think these two look great together.
I don't know what the odds are. I think that there's a very high likelihood.
I'm just saying, like two of the biggest interest rate journalists out there, next to the old guard.
Much lower growth, and we're seeing that now. So the
looking
median
sharp,
forecast,
boys.
I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really
set
are
ourselves
suffering
up
from
really,
inflation.
really,
and
light the way
if we want
to
to set
another
ourselves
period.
up, really light the way to another period of a very strong labor market. We have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability and you've suggested maybe there isn't a trade-off in the long run, but in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for
I wouldn't rewound back in this, and I've got a screenshot here
wage increases
that is
eat up
just
inflation. So if you're
just off,
family
perfect.
is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation.
Look at that.
Basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's
much
not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, that's a good thing. For the longer term, what we need is supply.
Oh my gosh, you haven't had this one in a long time. The best adult dating site decided to visit us again.
And that people can afford houses again. And I think we probably in the housing market have to go.
What is the interest rate right now? Which interest rate, X Rod Capital?
There are also longer run issues, though, with the housing market. As you know, it's difficult to find.
The federal funds, it's 3 to 3.25 now, right?
Things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Last question already. We're ending early?
You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you could pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But, I don't know exactly what it would be. But it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Well, that was a little shorter than it usually is. Wow, you made 3,700 in sim trading? I should have been way more aggressive, right? Because I nailed it, man. I totally nailed it. Remember earlier on when I was like, well, guys, the bonds are down, but the cumulative delta has been rising this whole time. If I had taken it in, if I had gone like full bore in on that one, would have been amazing. I only bought it once we were getting close to the overnight highs and, bought it before the breakout and took $500. And I thought that was an amazing, that's a win for that indicator. Yeah, cumulative delta knew what was up, huh? I mean, I don't think that we can make a trade based purely off of that. And there was a period there when I took that later one where it was looking a little dire for me. So yeah, now I you know what, we got a tweet here because Edward Lawrence, Michael McKee, and Steve Leishman sitting there together looked so boss. We have to tweet this. We just have to. Where is it? Where is my picture? Steve Leisman, Michael McKee, and we'll add in Edward Lawrence there too. Sorry. So like maybe you guys don't find it as no, it went. I was only trying to like market make that small area and then have one run. So I only let one run. And then I took my one lot off at exactly the high. So I have to think that somebody was helping me out there, man, because that's a little bit too prescient, isn't it? Dude, I didn't take any live trades though. Really, I should have, right? I should have bought, could have made, well, what are we at now? Whoa, 50. And we were at one point at like what, 620? Yeah. So could have made $70 here if I had faded. There's no way I would have faded that with the live. This whole move has been a little bit zany, right? Okay, yeah, I'll walk back for a second. These three sure look mouse together. Steve looks like he's about to shoot laser beams out of his eyes. Don't you think so? Don't you think like if those glass here, wait, I gotta make it bigger. Where is it? Let me pull it off of my hard drive here. I bet maybe somebody would get a better picture of them. Maybe somebody got a better picture of them. But this was the best frame I could find. I thought these three look awfully sharp. They look awfully sharp. And Steve Leishman, come on. Like if he pulled his glasses down, I think laser beams would be coming out. Don't you think? I think so. Yeah, so Tweet, tweet. Okay, so here's what I was thinking. Okay. News comes out, we immediately slam down to the bottom here, okay? And I'm reading it. Everything that I'm seeing is in line with my expectations. Everything that I'm reading is in line with my expectations. So the very first thing that I'm thinking is market's not informationally efficient. Everybody would think, okay, well, the market's moving down. That must mean that the market sees something about this that is bad. But since we understand that the market's not informationally efficient, we can come in and we can make this call that, well, the market's not moving in line with the fundamentals, and eventually it will, right? And because you leave such a big liquidity hole behind you, yeah, you got a really good chance of it coming all the way back. Now, once it started to extend above the original price, that's when I started to feel a little bit more confident. So at that point, you know, and the big key was, again, if we come back to these charts over here, need to zoom this out a little bit. Look at cumulative delta, man. The market orders never stopped being buy. Market orders is your best indication of informed traders. So the other informed speculators were all buying the whole time. So that gave me confidence to try and take a swing at it higher. Okay. Now, when I came in and I took the trade on it a little bit higher, I don't know if I got my entry perfect, but I could kind of see that there had been this distribution up there at the top before, and that there was a little bit of a possibility of them rotating around that area. So I said, okay, I want to start market making in this area now in the hopes that I can get the lower end of that range before it pops out. So I didn't get as low as I wanted. I think that I got 113.30, and it would have been better to get like 28. Okay. But I took it off a few times, 2 or 3 times in here. And then the second time that I got filled, if I had had the chance, I would have canceled the orders because it popped back up so hard. Oh my gosh, that snapped back up so hard when it went. And then it went on. I just put it at $500 just cause. So that's where I find this a little suspicious. It's like, okay, well, I only put that order out there because it would have been $500. Just to have a nice, clean, even profit. That it went like exactly up there, traded just enough to fill me, and then it came back down is a little weird. just a little weird. At 3:15 p.m. is that when you said it? Snap. I don't remember when we pointed out the cumulative delta. I think I pointed out the cumulative delta thing just before the Federal Reserve meeting started. So it was probably more at like 12:25. Right? But immediately after the news, my first thought immediately after the news was I want to buy the dip here, right? I did catch that. And the first price that I picked was $38.60. Well, you would have gotten your rewards worth if you'd taken your profit on $38.60, because we went down to $38.30, but we also went as high as $39.20. So if I did 60, that would have been 40, 50, 60. Yeah. So we could have made $60 off of that and risked $30. Well, not $30. It would have been 300, right? It would have been risk 300, make 600 on a micro contract. That is actually that's a little scary to me. a little scary to me. A risk. I have the margin to put that on there. I would have been like a 50% winner on this account though. No way I'm going to do that. But yeah, so to be short, the market was wrong and I knew it. I'm not confident enough on an FOMC day to make a trade like that, though. Maybe if I had a much larger account, I could speculate on those sorts of things. But the issue is that even if I'm right, how far is it going to go, and are you going to hold a stop? Like with the amount of risk that I like to put on, I wouldn't have made that one, right? It would have gone too far against me and I would have puked. But I had the, if I was going for a swing trade, could have worked out. Now, over here in the dollar, it is still frozen, apparently. Reload all historical data. See if I can get it to fix. It's probably the case that one of the sub-instruments is having an issue, though. That's the first time it's ever quite happened like that. Okay, what about the fundamentals suggested that the price was moving the wrong way and should correct itself? So I wouldn't call it fundamentals. Well, I guess I would say, so it was the market expectation, right? So I was expecting 75 basis point hike and terminal rate around 4.5%. Okay. And that's exactly what we got. Was they raised interest rate 75 basis points, and the median dot plot for the terminal rate was at 4.5%. There was some above that. There was like some at 4.75, but the median plot was 4.5, right? So if everything is coming out in line with expectations, why would treasuries and the indexes sell so hard like that? That makes zero sense. It makes zero sense. And then especially when the cumulative deltas are going the exact opposite way the whole time, that's fishy. It's very fishy. But we have to remember that because the market's not informationally efficient, if it's going down, it could keep going down, right? It could keep going down. That's why I wasn't looking to take this way back down here when it was like at 12. When it was 113.12. No, sir. Because that can just keep going. But once it starts to get sucked back up into the liquidity hole that gets left from the news and everything, and then they get above the news price. So above the news price, you would expect there to be better liquidity that's been sitting there for longer, right? But even after they get through that, volume is still looking strong, right? That's when I'm feeling really confident that we are getting, for whatever reason, we are getting an order flow correcting that problem. Now, it could be that all of these guys went short immediately on the announcement and they're having to cough it up higher, right? I think that's probably the most likely explanation for what happened. ZB running into a crazy amount of positive gamma. Well, have you ever watched that right at 1 o'clock? So there's no mistake that the high in the 10-year treasury happened right at really, really close to 3 p.m. Eastern time, 1 o'clock my time, because that is when the treasury options pit closes. So after that, you're going to see a lot less activity. Are liquidity holes where price? They can be. Yes. So remember, what is a liquidity hole? Low resting liquidity. So what are the sorts of things that can create low resting liquidity? Well, sometimes it just kind of happens on its own. Okay. But the three things that I think are the most likely to create low resting liquidity is a large transaction in one spot, a very quick and impulsive move, or sticking around in an area for too long. Those are all three things that could exhaust the resting liquidity and create a liquidity hole. Right? So yeah, when you have FOMC and immediately on the news, I mean, you'll see this pattern on almost every big news item, right? It'll go, so here we are, here's the news, and then badoosh, and then it comes back, right? Now, sometimes it comes back like we did here, and it goes higher. Sometimes it goes, oh crap, and it keeps going lower, right? So in both of these instances, in this instance, what happened was somebody comes in and takes a trade the opposite direction starting here, and that pushes it the other way. Whereas in this situation, people just continue to sell, right? But you will always see this kind of in after a big news event like that, you will almost always see them get sucked back up. And that is them getting sucked back into the liquidity hole that they just created. After a really impulsive move like that, you get a really, really strong liquidity hole. And you got to be careful with these because it's a really volatile in this area. So even though, like that was my immediate thought after hearing that would be like, there's a totally technical analysis based trade that I could take that would be reliable, right? No, because it's too volatile in here for you to hold a stop. You're probably not going to be profitable trading those because of the volatility, even though you almost always know what's going to happen. Right? Well, I'm in good spirits. That was quite an exhilarating FOMC. I feel really positive. The S&P 500 does not feel so positive right now, though, do they? Yes, they came all the way back, but if you had held it, if you had said, hey, this was a great trade, Seth, I'm going to hold it, you'd be not happy so right now. We still got 30 minutes, so we could see some covering. But I guess the treasuries can come in and they can say, we're at a good price. This is the right price. Excuse me. We can say in the treasuries, this is a pretty good price. This price is pretty close to in line to what the market expectation should be at this time right now, right? But can we say that for the S&P 500? Not so fast. Things still look not so good in the S&P 500 because higher interest rates are generally not good for stocks. Why is the ES always falling when there's a Fed meeting? It's not always falling when there's a Fed meeting. We rose last meeting. Where were you last month, Axelrod? We rose last month. It's funny because when I first started streaming, when we first started doing this stream back in 2017, I bet you that people would have asked the exact same question the other way. Why does the S&P 500 always rise after a Fed meeting? Right? Because it was always like, well, yep, interest rates are still zero. They'll probably still be zero until the end of time. That's how it went. Oh, man. Man, oh, man. It is. Now, so here's another. Now that we're through with the day, I didn't really take any trades, right? But sometimes the day after is more important, right? Give the market like 2 days to sort it out because not everybody puts their orders in right during the Fed meeting, right? Some people, they go home, they sleep on it, they strategize with their colleagues, and then they decide to make the move on Thursday morning, right? Or they make a move going into the close of the week on Friday. And so we shouldn't make like a huge conclusion about what this means for the larger economy yet. But the S&P 500 doesn't look too happy, does it? Doesn't look too happy, does it? In fact, it looks quite not very good. I still don't know who's buying the S&P. It's a good question, Mr. Bond. It really is like nobody's bullish these days, right? Nobody's bullish these days. Well, and we don't have stock buybacks this week. That's another thing. It's always buying. Yeah. Well, it's just like the yield curve is the same way, right? If you go into the S&P 500 and all you do is buy, generally you're going to do okay. Generally, overall, you're going to do okay if all you do is buy. Okay? But the problem is that when that doesn't work, it like really doesn't work. Like it really doesn't work. So, you know, and it does the same thing with the yield curve. Generally speaking, the yield curve will tend to flatten. And it's just that one time period when we have a recession and the interest rates the short end interest rates come back down and we get steepening, that all of these people that do nothing but flatten get totally screwed over, right? So and if we go down another 15%, people are over leveraged, and down 30%. Yeah. Well, but I don't think that people are excessively long the market right now, though. That's the thing. Like again, 3,800. What does the gamma look like at 3,800? Because I mean, I know that the gamma has really, really cooled off compared to what it was at the beginning of the year, but that would be a key place to want to know where the gamma positioning is if they're long or short gamma. When you rode the uptrend since COVID. Oh, geez, yeah, this. I have seen so many threads on Reddit lately, and to be honest, I've really enjoyed them, where there's all these traders that are like, I had it all figured out, and I was doing so well for many, many years, and I was a profitable trader, and now all of a sudden, in the last month, I've given it all up. Well, you didn't actually figure it out, did you? You were just lucky. I'll never say that. There's been a number of threads like that. Like serious. There's this one guy in particular. He had made I think he had made $280,000 in the stock market doing all this, and then he's like, I gave almost all of it up. And people were telling him, well, you were probably lucky, and he didn't agree. Of course he didn't agree. Yeah, people will give up all the gains on the last 2 years and the last 6 months. Yeah. Well, I mean, listen, if you're in stocks, Mike Butcher said this. If you're in stocks, you lost money, right? I lost money. I was almost my small stock account was almost up to like 7K, I think it was, and now it's back down to like 5,500. It's a better. I've had a better year than like the larger index, but man, it's been ugly. It's been an ugly market. So, shall we come in? I don't know. Well, let's hang out here. Let's hang out until the S&P 500 closes, because I feel like that the equity indexes are being a little too negative here. Well, I don't know though, because if you're going to see like rebalancing into the close and that sort of a thing, that usually starts to kick in at the bottom of the hour, and we're not really getting any of that at all yet. So maybe that's not a good call. Maybe that's not a good call. That's why the best investors in the world make 20% year over year. Wait, why? I don't think I understand what you're saying. Risk management is why they make 20% year over year? I don't know. I don't understand. Oh. Well, I'm sitting, I'm starting to, I mean, I still have like 2 hours left of work after this, but my mind is already to like, do I work out today? I mean, I have to work out today, but I'm not. The pollen here in Utah hasn't been good lately. I don't know if it's like always a thing like that in the fall or if I'm just overly sensitive to it, but like my allergies have been bad. and working out means going out into the garage. It means going out into the garage. Don't know if I want to do that. You would think that living in Utah would mean you're in a desert, so your allergies shouldn't be so bad, but oh, you just moved to Utah? Where did you live before that, Trading Bunny? I'm just saying people who make 100% don't realize you're in. Oh, right. Oh, you came from the north. That's got to be a really jarring change coming from Portland to Utah. Well, I mean, on one hand, the nice thing about really the whole Western United States is that the most common hobby is being outdoors, right? So they have pretty good outdoor culture in Washington and Oregon, and they have pretty good outdoor culture in Colorado, and it's really good here in Utah. But like the actual culture, like the political culture and stuff, Portland and Utah are like diametric opposites. Portland is a dumpster fire these days. Is that why did you move out of there, or did you? Oh, well, I don't know who would call me at this time, but that's kind of weird. That's interesting. So I have this theory that the social networks, should we say, like YouTube and Twitter, is like more likely to show you somebody because they're a local, is I think. Oh, really? I'm so sorry to hear that. 86-year-old mother got hit by a car? That's like the most Utah thing ever, though. That's no, I don't know who's calling me, but I'm not talking to you. 646. What's the 646 number? Is that Chicago? It's New York. Somebody from New York is calling me. Sorry, not today, New York. She's fine. It just can't move around very much anymore. That really sucks. Oh, there used to be. You know, have you ever seen in Utah they have like those crosswalks where you have the flags and you can pick the flag up to walk across the road? It's because too many people were getting hit. So your mom being involved in a pedestrian accident, that sounds pretty Utah to me. This is kind of a little messed up to say, but man, that's funny. That's really funny. So treasuries, when they peaked really hard after the options pit close, the amount that they came back, I don't know. Sometimes my, what do we call, calibrations get off a little bit because we're in extra volatile market, right? So extra volatile market, liquidity is not great. I guess it should come back a lot, but it came back a little bit more than I expected, but it does look like they're going to settle somewhere up here in the 07 area. Well, I mean, they could just as easily do it here, but somewhere here above 114, it looks like they're going to settle. So we'll watch that. Watching interest rate markets and understanding the Fed would do a lot to help retail investors understand the macro events that influence markets, and then they watch Jim Cramer on Wall Street Bets and buy the dip. Well, you know what? Like, again, I think the most important thing you can know if you want to be involved in markets, and listen, I'm never going to try and convince somebody to do it. Okay. Trading is hard. It's hard on you. I mean, look, you can't really tell too bad, but I mean, there's some gray hairs here in the beard now. I'm only 37, okay? There shouldn't be this much gray in there, okay? It's definitely it's definitely worn on me, okay? It's definitely here we got the best dating site again. Gotta fix that. Oh dear. Sometimes there we go. Hide user in this channel. Anyways, so I'm not trying to convince people to trade, okay? But if you're going to trade, the way to do it, you gotta understand the markets are not informationally efficient, right? And that orders are what moves markets, right? Orders are what moves markets, because everybody comes in with this preconception that they've been taught by society. Markets are efficient. We're all taught the efficient market hypothesis. So that means that the price that it is right now should be an accurate reflection of all available information. It's not true, but that's what they teach you, right? And they teach you that, the technical analysis people teach you that you can use that to ride the trend or whatever the deal is, right? So when you come in with that kind of thinking, then there's going to be all sorts of moves that you can't explain. It's going to be like, well, the FOMC happened and they moved down, but then they immediately reversed. Why is that? And most people just chalk it up to noise. Oh, there's noise and there's extra noise on Federal Reserve Day, right? But once we understand that the market is not informationally efficient and that it's the orders that move markets, now we can come out and we can say, okay, why did orders initially sell and then later buy? Well, could have something to do with positioning. I think that there were some people coming into today's meeting that had they expected the meeting to be really good for equities or something like that, like they had some dovish bet on and it didn't work out, right? So they're puking that as soon as they find out that the rate hike is 75 basis points or something like that, right? And then after that, then the speculators come in that think, well, this should mean absolutely nothing because it's in line with the fundamentals. You get what I mean, right? So when you understand that it's the orders that move the market, so you come into a completely different paradigm. Now you can look at these in terms of moves. Had this move, it moved down, and then there was a move that moved the other direction. And every one of those little trends, we're going to try and attach an order flow to it. Why was that order flow coming in the market? And sometimes it is based on changing expectations about future fundamentals or order flows, right? And that could move the markets. But it could also be positioning. It could also be funds rebalancing. It could be options. There's all sorts of things that could be possible predictors of order flow. So now you can make theories, right? You can here's all of my possible theories, things that I know of that might have moved the market there. And then as it continues to move around and as you get more information, you can kind of cross certain theories off the list. Well, this one doesn't make sense. This one doesn't make sense, whatever the deal is, right? Now you have a framework where you can actually understand what's going on, right? Because otherwise you're never going to be able to explain it. Now, at least you have some idea of what you can explain and what you can't explain and what are the possibilities in terms of why it came out that way, right? You have to understand first, though, that market is not informationally efficient. Now, to the other side, though, having a hard time determining a long-term directional bias. Well, first of all, you kind of want to sit down and be honest with yourself about how far ahead you can actually predict things, right? Like I can come in and say, okay, if there's a piece of news, I think I know where the market is going to go, at least for the next 30 minutes. I don't think that I could make a very accurate prediction of what the S&P 500 will be a week from now, though, right? That'd be too hard. So first you have to be realistic. But second, a lot of it is just experience, right? Now, if you're going through that process of coming up with theories about what is driving the order flow and, confirming and rejecting your theories based on further evidence that you get, what you're doing is you're going through that process is you're learning how the market works. You're learning the things that are the most influential on the market and this sort of thing moves in, this sort of thing doesn't matter. They care about this, they don't care about this. You only learn that stuff from experience. And frankly, it takes years. It takes years. I've only been futures trading for the last 5 years, but I've been watching the stock market for, well, since I was 21, basically. Was I 21? No, it was more like 24. But since the 2008 crisis, right? So that's a lot of time. I've seen a lot of Fed meetings. I can remember the Fed meeting when they announced quantitative easing too. I think that's probably my best memory ever. Was I worked for a firm, worked for a big bank, and everybody was arguing about it, and the market didn't like it. They're like, well, they wouldn't be doing quantitative easing if things were good, right? That's what they said. And all of the traders at the bank were saying, this is so great. We're going to get so much business because of this. And I was like, oh, okay. So actually we want to buy this, right? Market ended up down on the day, and that was like the best time to buy stocks ever. Like ever. Market was dead wrong on it. I think that was when I first really realized that the market really isn't efficient. That the efficient market hypothesis is just, I mean, there's some usefulness to it from an economics perspective for certain kind of economic models and stuff, but it's not the reality. And anybody that's traded and watched these markets will know that. And it's kind of crazy that there are some academics that still cling to that idea because it's just clearly not true. Man, they're coming back now to 114 even. I said I think that they'll probably settle somewhere above that, and now they're coming back to 1400. So I guess 1400 would still be a fine place to finish. By the way, what happened with gold in the end? Let's come over here to a chart. So I think that what happened, gold had a down move initially, but is that a weekly high in gold? Wait. We got to come over to the volume profile chart. Get a little bit further back look. Okay, so it is the high of this week, but it's not the high from like before CPI, for instance. In fact, that like 1750 might end up as being really hard resistance if gold is able to pull out some sort of a rally. But they got a little bit of a rally because of the whole Russia thing. Then I think the reason they got a bit of a rally after the Federal Reserve meeting was because the dollar falling back down. So still, that is a big change from the past. So I wonder, man, it sucks that my dollar index here is not loading back up. I probably have to restart NinjaTrader. Something with the data on that got screwed up. Something with the data on that got screwed up. Oh man, so you know what's been going through my head because Trading Bunny said that they just moved to Utah. Now I'm thinking about Ace again. haven't heard from Ace in a while. Maybe he should stop by and say hi. You go tell him to stop by and say hi, just for one day. Oh man. Oh man, Michael McKee retweeted me. Ah, that's so great. That's funny. Oh boy. But only one person liked the tweet. Come on. That's like one of the best retweets I've ever gotten, and nobody likes it. Guys, I don't understand Twitter. Why am I so terrible at Twitter? Don't get it. Maybe I just need to be patient. Wait, how long ago did that happen? Oh, he only did it 3 minutes ago. So we're cool. We're cool. We're cool. Because if I'm Steve Leisman in CNBC, I'd be sitting like, oh, you know what? That guy on Twitter, he's right. They do look pretty boss. And Steve Leishman does look like he's about to shoot lasers out of his eyes. He's gonna shoot lasers out of his eyes, guys. Don't you see it? You see it? To be honest with you, I don't have much more to say, and I'm just kind of killing time until the S&P 500 closes here. Want to see what the final close? Do you think? Ooh. Okay, 5 minutes left is probably a little bit too much for them to sell and close. By the way, oh, you know what I need to do? I need to turn my news squawk back on. Turned it off for the press conference. We need to see what the market on close imbalance is. Okay, so at 1340, it was 98 million sell side. Well, that's not very much. That's not very much at all. So we'll be careful. There could be some really big orders for the market on close that aren't. Oh, no, wait. But we've already been past that, right? Oh, yeah. I'm lost track of time. That would have been 5 minutes ago. So I didn't hear what it was. Oh, well. But there must not have been too surprising since the market didn't really do anything too wild when that came. So maybe that does mean that they close somewhere near the lows here today. Doesn't mean that the S&P 500 can't recover tomorrow, but we'll see. We'll see. This is my new favorite thing. Because I'm always like, I don't know. And I always feel dumb when I say I don't know, because like it's not actually true that I don't know. I really should just say we'll see. Because nobody knows for sure, right? Nobody knows for sure. Oh man. Today was a fun session. Well, they did bounce off of 114 even, didn't they? That's curious. You know, I love to rag on technical analysis. And the thing I find the most hilarious about technical analysis is that there is more edge in watching round numbers than any other kind of technical analysis that people pull up. You know, like they talk about fib numbers and stuff like that. Ignore the fibs. Just go for even numbers, man. 114 even. Round number, any round number. 138.
Expecting some comments
00.
Who's speaking at the
An
Global
ES.
Fund 7th Replenishment Conference.
Those all matter. You don't want to hear them. Turn them off. Turn them off. Oh yeah, and turn here's Howler's stream beats on. Ooh, hey, it is okay. Now that it's been about 5 minutes, now it has likes. I don't think that any of those people are following me. But at least I think I finally had success with a tweet. Finally had some success with a tweet. By the way, D, I don't think you ever told us, you know, like you decided to take a gamble before the news. Was it long or short? And what did you do with it? Did you do it? Of course, a gamble on a sim account. Don't gamble with the live account. Oh yes, it was your. Oh yeah. I hope that you took good profits on that. That you saw the 1960. Oh, okay. Oh, that's how much you made. Well, what price did you take profits at? Do you remember that? Well, that's not bad. I don't know. What you couldn't have made that with just micro treasuries, though, did you? The 171. Oh, you just traded the live treasury and you made 5. Yeah, okay. Yeah. No, that's a really good winner, though, man. That's a really good winner. That's a 10 tick trade. I don't know what the deal is, but I haven't traded the full ZN for a long time. But like the bane of my existence used to be that I'd always get the good trade. Like I'd go 10 ticks and then I'd leave it on and it'd come all the way back. And it seems like that no matter what I did, I could never make more than 10 ticks. And then I'd be like, okay, I better take my profits here. So I'd take 10 ticks profit and then it would run further. It was like no matter which way I played it, I couldn't get more than 10 ticks. And now, of course, the market regularly moves like a whole point. Oh, you just started trading futures, Tommy? Yeah. No, that's what I'm talking about, Trading Bunny. I'm with Ninja Trader Broker, and they don't offer a micro 10-year note. They offer micro yield, though. Yes. So yeah, I'm talking about. I usually put my orders in 10YR, or I guess it depends on if you're using the codes. It's 10YU2, but I'm talking about like ZN. So the full treasury future, which is different from the yields. So I think that what D is saying is that he did take a short on Sim, but he also took a live trade and made about 10-ish ticks on a live trade in ZN. Yeah. I looked at so many things I can conclude that the root of all this, that technique's most important is understanding bid and ask. Like I said, the big issue is that because the market is very statistically efficient, it's really hard to look at any piece of technical market generated information and make a prediction out of it, right? But watching the order flow, and that means, yes, looking at the bid and ask and looking at the orders hitting into them and seeing how many orders went through where, that will give you the best understanding of what happened. There's a lot of things that you can't understand. Like, I'll give you an example. So say we have a really big spike in volume and it moves, it doesn't go anywhere. Like, there's a big spike in volume, but it doesn't move very much. Okay, so was that market orders pushing both ways, or was it buyers pushing up into a limit sell, or was it sellers pushing down into a limit buy? You can't actually see that when all you have is price and volume, right? So that's why you need the order flow. The order flow is the only thing that really truly tells you what was happening. It might not be predictive, but it's still very useful information, because then you can kind of contextualize everything. So Tommy, you were talking a little bit earlier. You're saying you just started trading futures. Have you been trading the 10-year, or are you just kind of poking around? Because the recommendation that I usually make to people, should I say the recommendation I usually make? I think that for futures trading, you want to pick one market and understand that market really well, right? Mine is the treasury market. So you want to try the treasury market, trade the 10-year treasury, ZN, trade ZN on SIM for a little while. And then when you've thoroughly given up on that and you think, oh, I'm never going to figure out ZN, maybe then you can try a different instrument. ZN is hard to trade, man. I've had lots of success since I switched to the micro treasury yield futures. But before that, when I was trading ZN, it's so hard. Oh, it was so hard. These days I get away with it, trading it on SIM and just taking a lot of risk on for fun. I mean, if the trade that I had taken today, the SIM trade that I took today, if that hadn't worked out, that would have been really ugly, right? Yeah. Okay, well, the ES did settle down there at the bottom. So I think it's time for me to get going, guys. Got some things to do. Gotta get myself amped up to go and work out. I don't really want to. Good day though, guys. Good day. Fun times. Oh man, and I still need to go back and clip that whole thing with Steve Leishman and the Fed president. That was so funny. Okay. So, I'll see you guys tomorrow. In the meantime, stay excellent, team.